Hello everyone, welcome back to the YouTube channel 30CAGR. In this video, we are going to discuss about trailing stop loss. But why are we doing it now? We are doing it now because in my last monthly P&L video, I told that we are shortly introducing trailing stop loss in our ISS trading bot, right? And we recently introduced that last week. Many traders started asking us how we use this trailing stop loss and what are the percentages that we need to input in those two fields. If you are new to this channel or this strategy, this is a trading bot that we use for our ISS trading purposes. If you see, we have introduced two new columns. One is trailing range X and the other is trail SLY. So I thought I'll make a video to explain this in detail on how to input these X and Y values or how this entire calculation works. And of course, along with that, we will also be discussing some other important topics that hover around this concept. All right, my name is Raj Konakalla and 30cagr.com is my blog. There are two flagship strategies in my blog. One is called ISS, which is for intraday option traders, where they can earn monthly consistent returns like 4 to 5% on an average. And the other strategy is called PDR, which is a short term based strategy for working professionals. In both these strategies, we aim to earn around 40 to 50% returns per year without spending too much time in stock market. All you have to do is maybe just spend 5 minutes per day and earn a huge returns at the end of the year. If you would like to know more about these two strategies, you can go to my blog and check them out. And lastly, if you are an option trader, you can also avail free trading bot in this blog. And before moving into the topic, if you haven't subscribed to this channel, please subscribe immediately and hit on bell icon. All right. So before we move into the topic, I would like to say that there is a lot of criticism, ambiguity, and debate whether this trailing stop loss is useful or not. What I would say is it really depends on your trading objective and style. Let us say you are a long term investor. Maybe in that case, trailing stop loss is not very useful because sometimes stocks might come down a little bit and then again they bounce back. So in that case, even if you put a trailing stop loss, the trailing stop loss gets hit and then again the stock starts moving up. So if you are a long-term investor, maybe trailing stop loss is not a good option. However, if you are a short-term trader or a day trader, then trailing stop loss gives us a significant advantage. So we will see all the points now, but for the benefit of beginners, let me simplistically explain what is a trailing stop loss. Let us say we are trading in a stock or an option where we sold a call option or a put option at 100 rupees. Remember, we are not buying since we are option sellers. We sold this call option or put option at 100 rupees. Now, the initial stop loss that we have for this is, let's say, 30%. So the initial stop loss would be 130. This is the stop loss and this is the entry price. If you look at the greatest traders or trading strategies in the world, two things that they always do to be successful are first is they cut their losses quickly. So the first point is about the stop loss. They don't wait until their losses are big. They immediately cut the losses and come out of the position. And the second thing that they do is they never limit their profits. They let their positions run into massive profits. It's a huge mistake to limit our profits. Okay, in any trading strategy, as long as you are riding on profits, you should hold the position. These are the two most important concepts of any good strategy. But how do you implement this? One solution to implement both these together is trailing stop loss. What happens is we have a stop loss of 130 initially and our entry is at 100 rupees. Now let's say our option or our stock is moving into profits. The stock is falling and we are running into profits. Let's say it became 80 rupees and so our profit is 20 rupees. Now, as soon as we get 20% or 20 rupees profit, we trail the stop loss also from 130 to let's say 110. Because we moved to 20% towards profit side, we also trailed the stop loss to 100. And let's say this 80 further fell and moved to 60. And in this case, our stop loss also becomes 90. Now, even if market reverses, goes back and then hits the stop loss, we are still exiting at 90 rupees, which is 10 rupees profit in this case. So simplistically, this is what a trailing stop loss is. All right, now let's talk about some important points before we actually see how we implement this trailing stop loss in our ISS strategy. First thing that you need to remember is the accuracy comes down. Not just in this strategy, in any strategy, if you implement trailing stop loss, the accuracy comes down because there might be some instances where the stock moves back and then hit our trailing stop loss. So we need to understand that the accuracy comes down slightly. In this strategy, maybe 3 to 4% the accuracy comes down. But in all my webinars, I stress on this point, you should not be looking at accuracy alone. Whenever you are picking up a strategy, whenever you are analyzing the backtesting results, you need to combine this accuracy with risk reward ratio. Only then it makes sense. What this trailing stop loss does is it increases the risk reward ratio a lot. So whenever you are losing 1 rupee and then gaining 1 rupee before TSL, maybe after implementation of TSL, risk will still be 1 and then the reward might move to 1.25 or 1.5. So in this case, even if accuracy comes down a little bit, that is still fine. Because as I said, we need to combinedly look at these two parameters together. And that's precisely what is happening here also. With implementation of TSL, there might be a little drop in the accuracy, but then risk reward increases, which ultimately benefits us a lot. And then the other thing is profits slightly increase. So at times you see that profits increase a lot in some strategies, but in this strategy, profits increase slightly. This is not what the major advantage is about this trailing stop loss. The major advantage is the drawdowns. Drawdowns come down significantly because of this trailing stop loss. Earlier, if the drawdown was around 15%, now it comes down to around 10%. So a reduction of 5% drawdown is huge for any trading system. That is the reason why we are implementing trailing stop loss. And then the next is max loss also comes down. This is also very important. Let us say there are days when markets are going in both the directions. Now, since we are trading in short straddles in ISS strategy, we sell a call option and then we sell a put option. Let us say both we sold at 100 rupees. Now, if markets are moving up, then this CE, which is at 100 rupees, this might become 130 and then hit our stop loss. And on the other side, this PE, which again we sold at 100 rupees, this might become 70 rupees and give us profit. Now, when this PE runs into profit, we immediately trails our stop loss here from 130 to, let us say, 100 rupees, which is like cost price. Now, even if market falls, then our PE leg will not end up in loss, right? Because market fell again and then our original stop loss of 130 we moved to 100. So it comes back, it hits this 100 rupees stop loss and then we exit at no profit, no loss. So in PE, we get no profit, no loss. And here we got a loss. Had we not have this TSL concept for PE leg, we might have got extra loss here also. It might have hit 130 at PE side also. So at CE side, we might have got 30% loss, and then at PE side also we might have got 30% loss, which is like 60%, right? But because of this TSL, we are escaping this 30% PE stop loss, and we are only getting 30% loss. What this does is this helps us to reduce the maximum loss on any given day, especially when markets are moving in both the directions, which is very important. So the major advantages of this trailing stop loss are these four. One is risk reward increases, profit slightly increase, drawdowns come down, and max loss also comes down. And with all these four advantages, there comes a disadvantage, which is accuracy comes down a little bit, but I think that is still fine. I have an Excel spreadsheet that explains this concept in detail. Now, let us say we sold a call option at 100 rupees and then we sold a put option also at 100 rupees. Or let us say only one leg so that it will be easy for you to understand. All right. So we sold a call option at 100 rupees and the initial stop loss is 30%. And so the original stop loss would be 130. Now, what happens is in trailing stop loss, it asks us for two parameters. One is X and the other is Y. We need to understand what X is and what Y is. X asks us when this trailing should start. So that's precisely what X is. If you put 20%, then you are instructing the bot that start this entire trailing concept when the leg moves 20% into profit. You can see 80 here, right? So our initial entry is 100, and once the leg starts hitting 80, that's when this entire TSL kicks in. Okay, and then the second input is Y. Now again the bot asks another question. All right, now I will start this entire trailing concept when your leg moves into 20% profit, but how much should I move? And again we give some input here like 10. So whenever this 100 rupees becomes 80 rupees, then our original stop loss also will be trailed by 10%. Now one question that you might ask me, what is this percentage? How are we calculating these percentages, right? That's the most important in this strategy. X is always a percentage of entry price, whereas Y is the percentage of initial stop loss. Here we have given 10% as Y value, and then our initial stop loss is 130. So 10% of 130 is 13 rupees. So the stop loss will be trailed to 117 once our option moves into 20% profit. As simple as that. Now that we understood how this entire concept works, we also need to remember one more thing. Once we calculate these 20 and 30, we convert them into points and then keep trailing in the same fashion whenever this option leg moves further into profit. Okay, so for example, first we calculate what is 20%. 20% of 100 is 20 rupees, right? So we calculate this 20 rupees and keep aside. And then Y is 10% of stop loss, which is 130. So we calculate 10% and keep it aside. Now 20 and 13 are the values that we need to keep trailing until we exit the position. So now let's see various scenarios here. Now our entry is at 100 rupees and we know that 20 is the X value and then 13 is the Y value. For every 20 rupees profit movement, stop loss will be trailed 13 points. So our option moves to 80 points and then the stop loss came from 130 to 117. Now next time when it comes from 80 rupees to 60 rupees, our stop loss comes from 117 to 104. And then if it comes from 60 rupees to 40 rupees, then the stop loss comes from 104 to 91. Okay, of course these are the percentages that I just used for explanation purposes, but when it comes to real-time trade, better values for X would be 30, 35 or 40%. Let's say you made this X as 40% and then Y as 30%. Now look what happens. Let me remove these two because these two values also change. Now we entered at 100 rupees. Now our X value is 40%. So 40% of 100 rupees is 40 rupees. And what we are saying is once our leg moves 40 rupees into profit, then trail the stop loss also by 30%. Okay. 30% of original stop loss, which is 130. So this 30% of 130 becomes 39, right? Now, once this option moves from 100 rupees to 60 rupees, then our stop loss moves from 130 to 91. Okay, so even if market reverses and then hits back, we will still be getting a profit of 9 rupees. Of course, these there is no right or wrong when it comes to X and Y. You have to backtest and see what suits you. Some conservative traders have these values a little higher, and some traders keep this a little lesser. It depends on what type of trader you are. So you can maintain anything between 30 to 40, and likewise even Y also you can put anything between 20 to 30. Beyond those values, probably it would not be beneficial for us. So just try to maintain this x between 30 and 40 and y between 20 and 30. Now, one other point to remember here is y cannot be greater than x. If y is greater than x, then you might end up in a state where your stop loss is below your current market price, which is not possible, right? So just ensure that your y value is always lesser than x. All right, that's all about trailing stop loss, and I hope now you know how we are trailing the stop loss or how the bot does this trailing stop loss. One thing to note is once you set these values, the bot will continuously keeps checking the current market price and trails the stop loss as per your input. So again, as I said, you absolutely need not do anything. Just give the instructions to the bot and the bot will take care of everything. If you want to be in touch with me, you can join my Telegram channel or Twitter. And for free trading bot, you can also WhatsApp me on this number. If you like the content in this video, please don't forget to hit on like button. And at the same time, if you haven't subscribed to this channel, please subscribe immediately and hit on bell icon. Thank you and see you in the next video.